Hi guys, so I want to talk to you about financial statements again and going concern companies. So this may be an alien term to you if you've never, if you haven't worked for a company before, if you've never got involved in a company's audit, if you've never been involved in preparing a company's set of financial statements. You may be wondering what that term means. You've probably heard it in a lot of different places. And it's a really important term which is considered each year when the directors have their accountants prepare the company's accounts. So in a nutshell, a company is a going concern if it's expected to continue trading in the way that it has been with no major issues in terms of cash flow or going bankrupt. So what you're going to find, I've actually gone to the Tesco set of financial statements again. In my balance sheet video, which is in the fundamental analysis playlist on my channel, I'll put a link in the description below as well. You're going to find instructions on how I pulled up the Tesco PLC set of financial statements. You can get them on Companies House. So in every set of financial statements for a reasonably sized company, they're going to have been audited, because it's a statutory requirement for them to be audited once they get to a certain size, and the size is determined with reference to the Companies Act. It depends on the number of employees, the size of their balance sheet, and something else. I think it's their profit. I forget what the other thing is. You can find that in the Companies Act. But anyway, the point is the directors, every time they prepare a set of financial statements, the directors are required under the law to consider whether or not the company is a going concern. And if it's not a going concern, if they don't think it's going to be trading nicely the way it has been for, definitely the short-term future, short to medium-term future, they are going to be required to make a note about it in the financial statements, and the entire set of accounts would be required to be prepared on the breakup basis. So what does that mean? It means it's like you're going to chop the company up and sell it up for parts. So breakup basis means we're breaking it all up and selling it off in bits, and you're going to get probably less money for the assets that you've got sitting on the balance sheet than you would have expected previously, because you might be selling them off quickly if the company's running out of cash, that kind of thing. So the point is, why do we care about all of this? The point is, if you're doing your fundamental analysis, these things are going to probably be obvious in a large company like Tesco. I've just gone to the auditor's report. Let me just show you the relevant paragraph. Report on the audit of the financial statement. So a lot of it is very general wording. They do pick out particular risks. So they've got store impairment review, recognition of commercial income. What happens is the auditor will go through the company's activities and find things that they'll set out areas that they think could be a risk to generating errors in the accounts. Might be for an innocent reason, just because they think the staff might get it wrong in terms of how they account for things. But they've all got the same sort of general wording, apart from when they identify key risks. Their opinion is standard sort of wording. So if I just scoot down here, number 4, conclusions relating to going concern. In auditing the financial statements, we have concluded that the director's use of the going concern basis of accounting in the preparation of financial statements is appropriate, meaning the directors have said that the company is going to keep going for the foreseeable future, and it's not got any bankruptcy issues which are imminent. It's not running out of cash. It's not going to be in a position where it can't pay its liabilities as they fall due. The directors have said it's fine, and the auditors are agreeing with the directors. So the point is, if there was something wrong here, if the auditors went in there and the directors are trying to say, we think this is a going concern, everything is fine, and the auditors disagree, the auditors would kind of force the directors to capitulate and put a statement in here and deal with the going concern issue, because if they didn't comply with that, then they're going to get a negative audit report. So they're going to be in a tricky position. So this is one of the things you can look at. It might not be so insightful for such a large company as Tesco, but what you're going to find, if you're looking to buy shares in smaller companies, smaller, more risky companies, you can pay close attention to comments about going concern in the financial statements, comments about cash flow, liabilities, how much debt it's got, how long whether everything is okay, and whether the auditors agree that everything is okay. So I hope you found this video helpful. I just thought I would cover that going concern issue as a separate matter, because it is quite an important thing, and it's something which the directors are required by law to deal with and to comment on, and it can give you some clues about what's going on. Sometimes you might find that one of the subsidiaries in a group is getting support from a parent company because the subsidiaries' accounts are looking a bit iffy, and the parent is going to give them cash if they run out of money. So you can, if something like that is going on, if the parent has made a guarantee over the assets and liabilities of the subsidiary, that is likely to be a note somewhere in the accounts. So you can find little clues about whether or not the company is having issues if you look carefully and you know where to look in the accounts. So I hope you found this helpful, and yeah, if I have any further insights, I'll share them later. Thanks a lot, guys. Bye.